So if the bank values it at less than the agreed price, what would happen from there is you would either have to come up with the additional money, so that additional 30,000, or you'd have to restructure the deal. Myself, my name is Anthony Lindsay. I've been in finance for over 30 years. I've done everything from debt management to wealth management to lending and mortgages. The reason why I always share this information with people is that you know that what I'm telling you is not just from the perspective of getting you a mortgage, but it's also a holistic guidance and advice that you understand how to manage your finances. And when I talk about the debt management, one of the things that I did do was pre-litigation. So I was one of the people that at HSBC would look at a case file prior to foreclosure, before it went to court, to ensure that the bank had done everything that they could do to make sure that the person could stay in their home. I would go to people's houses. So I take getting someone a mortgage very seriously. I'm not just someone that wants to get you in a property, but not ensure that you can afford it and maintain the property. So to a degree, a broker is a middleman, but there's benefits of going to a broker. So about 15 or 20 years ago, and I'm looking at Halifax specifically, but Halifax is one of the biggest lenders on the market. Halifax only did about 15% of their business through brokers. Now they do about 75% of their business through brokers. So a broker is a middleman, but the benefit of going to a broker as opposed to going directly to the bank is the fact that when you go into your bank, you're talking to a mortgage advisor. And the reason why there's a difference between the broker and the bank staff as a mortgage advisor is the fact that that individual can only talk to you about the products that that bank offers. So they may be giving you the very best deal available from that bank, but it doesn't necessarily mean that they're giving you the very best deal for you. So it gives you more choice by going to a broker. I personally work with over 30 different lenders, and those 30 different lenders have different criteria. Also, service. Quite often, you'll find that a salaried employee isn't going to give you the additional service because you've walked into that bank asking for a mortgage. Whereas with a broker, we have to work hard to get your business. And we have, because we know that you have other options, we have to work hard to keep your business. And the last bullet point on there is protection. The FCA requires mortgage brokers to discuss protection with you because we're giving you an advised mortgage service. So we are required to talk to you about protection. And by protection, I mean life cover, income protection, and critical illness. We'd also talk to you about wills and your content insurance and your property insurance. So if you speak to a broker and they start talking to you about these things, it's something they have to do. And actually, they're doing the right thing because they're making sure that you and your family are protected. So who's involved in getting a mortgage? Now, there's three key people that are involved in getting a mortgage, and it would be your broker or the bank, the person that's going to get you the mortgage, the estate agent, and the solicitor. Now, the interesting thing about this is out of all three entities that are involved in the process, only one of them actually works for you. So the broker is the only person that actually works for you because the estate agent works for who? You can put it in the chat. Who does the estate agent actually work for? So the estate agent works for the seller, and they're not bad people. There are some bad estate agents, just like there's some bad everything. But the estate agent's job, and they're contractually obligated to get the highest sale price for the seller. So they don't work for you. So no matter how nice they are, no matter how they try to chat you up and be friendly, they are working for the seller. And when you come to the point that you're going to sell your property, that's what you want. You want someone that's going to work for you. And then the solicitor, although you're paying them, essentially aren't, they work for you, but they kind of just covering up all the legal stuff anyway. So they're responsible for making sure that all of the documents are executed correctly, etc. So I always advise people 6 months before you think you're ready for your mortgage, start speaking to a broker. Because a lot of the things that are going to reduce the options that you have when you're making your purchase could be remedied 6 months prior. So we can give you advice, and I'll give you some of that advice on the call. The other reason why I say that is because the estate agent, because they work for the seller, they're not going to want to waste their time with anyone that can't actually afford to buy the property. So they're going to ask you for something called an agreement in principle or decision in principle. Now, I do want everybody to know there is something called conditional selling. You may have seen it in the news. So please note, an estate agent by law cannot tell you that you have to have an agreement in principle prior to showing you a property. They also cannot pressure you into using their broker. So I'll say that again. By law, they cannot force you or pressure you into using their broker. Now, there's nothing wrong with an estate agent saying, listen, we have brokers that we work with, or we have an in-house broker. We'd like for you to talk to the broker. We'd like to have them qualify the deal. That's fine. But if you say, no, I already have a broker, or you say, no, I don't want to see that broker, they cannot make you feel as if you're not able to view the property or purchase the property unless you use their broker. And what I would say, if you're dealing with an estate agent that out the gate is going to do something that is illegal, then I would try to avoid working with that estate agent. All right, so there's a few uncomfortable truths I always like to share with people, just that you know what is going on with your deal and what the thought pattern is. So the first one is time kills deals. So that's essentially saying that the longer it takes for the purchase to go through, the less likely it is to go through. The other one is buyers are liars. Now, this is something that if you were to have a fly on the wall in an estate agent, you'd hear quite regularly. Now, it's not meant to be demeaning, but it is actually true. So let's be honest. If you were purchasing a home, or some of you are looking to purchase a home, you're not going to tell the estate agent what your top number is. If you're a seller, you're not going to tell the buyer that although we are marketing the property at 230,000, I'm willing to take, 205,000. You're not going to tell them. And then the estate agent who's in the middle kind of has to walk that tightrope between getting the seller as much as they can and trying to get the buyer to raise their offer as much as they can. So that's why they say buyers are liars. But to a degree, everyone in the transaction isn't being completely honest or forthright. And then another uncomfortable fact is that 50% of all purchases don't go through. And that could be because of the buyer, that could be because of the seller, it could be because of a range of reasons. And keeping in mind that there's no contractual or legal obligation for the seller to sell or for the buyer to buy until towards quite far into the process. So we're going to just look at the key stages of a purchase. There may be some things you guys know, there may be some things you don't know, but we're going to go through it just that you can understand. So the initial stage is the financial assessment. So that would be when you as a buyer start looking at your finances. That's where you're starting to see how much you have for a deposit, what your credit rating is looking like, how much a comfortable monthly repayment is for you. So that's the initial bit. The next stage, and this is the correct process to follow, the next stage is to get your agreement in principle. I'm going to say two things that are contradictory. An agreement in principle is very, very, very important. So that's the first statement. The contradictory statement is an agreement in principle isn't worth the paper that it's written on. The reason why I say that it's not worth the paper that it's written on is an agreement in principle is not a it's not a credit check. It's not an application. It's essentially you're putting information in a form and it's giving you a decision. All right. If you read the fine print, it will say that, this is not a binding contract. So I could, for anyone on this call right now, log into my portal and get you an agreement in principle for £1 million because all I'd have to do is put the right numbers in. So if you notice beside that, I've put £295. I'll come back to that. So once you have the agreement in principle, the next step is to search for the property. The reason why you want to get your agreement in principle before you start your search is because the agreement in principle, if done properly, will give you guidance on how much you can actually borrow. It will also give you guidance on who would lend the money. So you get your agreement in principle and then you start searching for the property. Once you find your property, there's a negotiation stage. So one thing to keep in mind is that the whatever price you see a property being advertised at, it's just a marketing price. It's not based on anything because although you look at properties in the area and the seller might have a feel for how much it is, a property's value is essentially what someone will pay for it. So you could have a house that all of the other houses around it are worth 300,000 and this house is worth 500,000 because one of the Beatles used to live in it. And someone would be willing to pay that additional amount because one of the Beatles used to live in it. Or you could have a property that's worth 300,000, but the property next door comes up for sale, and the person that owns that property wants a family member to move in next door that they can knock the wall out and make it larger. So they may be willing to pay more for that property. But the property value is what someone will pay for it. So what you want to do is make sure that when you're negotiating, you negotiate based on how valuable that property is to you and in line with what you think the bank is going to value that property at. Because although there will be a negotiation, once you've done that negotiation, what's going to happen is the bank is going to come in and do a valuation. So you may have agreed a price of, let's just say, £230,000 for that purchase. You may have agreed that with the seller, but once you get into the stage where you do the mortgage application, the bank's going to come in and do a valuation. One of three things can happen when you do that valuation. The bank can come in and say, yeah, I think it's worth 230,000. That's great. That's a good place to be in because then that means the agreement in principle that was in place converts into an offer and all the numbers stay the same. Scenario number two is that the bank could come in and value the property higher than the agreed price. That doesn't happen very often, but that could happen. The thing that you really want to look out for is if the bank comes in and values the property below the agreed price. So again, let's use that figure of £230,000. You found the property, I got you an agreement in principle for the £230,000 or minus the deposit, whatever. Let's just say £230,000 mortgage. And then the bank comes in and says, well, actually, we feel that the property's value is 200,000. So if the bank values it at less than the agreed price, what would happen from there is you would either have to come up with the additional money, so that additional 30,000, or you'd have to restructure the deal. Additional money, so that additional 30,000, or you'd have to restructure the deal. So it's always really important that when you're putting together your budget, you take into account that the bank's valuation is what actually counts because the bank is going to secure the mortgage against that property. So you get the mortgage offer. That's when everything really starts to move. That's when the solicitor goes into play and starts doing searches. What I do recommend is from the moment you start the process and have found a house that you're interested in purchasing, I would recommend you get a solicitor lined up If you work with me, I can help you find a solicitor. And one of the things to consider is not all banks work with all solicitors. So if you just have a friend or family member or someone that has referred a solicitor to you, do keep in mind that when you go through with the mortgage, depending on the lender, that solicitor does have to be on what they call the panel of solicitors that that bank works with. So you just go through all the legal stuff, then you exchange contracts, and then you move in. So that's a quick overview of the process. The current timelines in the UK are about 6 months. So that's the average. So you do have some purchases that might take a year, might take 9 months. You have purchases, especially if you're going through auction, that may take, 30 days to 45 days. But on average, it's about 6 months, and that's with no chain. And a chain would be if someone is selling their house but needs to find a new house to move into before they can sell their house.